Good morning, ladies and gentlemen. Well, unfortunately, the risk dial is still broken. We still can't display the correct prices, but we're making substantial progress. At least now we know what is wrong, and I have high hopes that by the end of this week we will have fixed it. No major changes. We're still here in the green, and the moving averages have not crossed. I will let you know if anything major happens, but we really should have it fixed by the end of this week. And having said that, again, my apologies, and let's immediately see what the yield curve is telling us and what the bonds are doing. And the funny thing is that the yield curve and the bonds are in complete limbo and are telling us absolutely nothing. It's been a while since I've seen the bonds trade in such narrow ranges with week-to-week changes of 1 basis point in both the yield curve and in the outright tenures. Really getting no clues at all at the moment from bonds, and what seems to be happening is that volatility is being sucked out of the bonds and being transferred to other asset classes. It happens sometimes, that's the way markets are. But I would say really for the yield curve in 2s, 10s, you go with a break of either of these levels. They're all marked on the sheet. It seems obvious that if we start breaking now this range that we have been in since, this is July, there should be follow through of at least 5 to 10 basis points. But at the moment, absolutely nothing in 2s, 10s to hang your hat on. And the rest of the yield curve, very much the same. 5s, 30s, they keep on closing within a, 1 or 2 basis points on the weekly basis. We still can't say anything much until we break 105 or 124. Those are your levels. If we go to the daily, you can see how we are basically in the same range that we have been for several weeks, moving, hardly a basis point. And, am I surprised? Yes, to a certain degree, because we've had a lot of events last week. We had the auctions, we've had a lot of Fed talk, but absolutely nothing. I guess people are waiting for the September FOMC, but certainly the more it coils here, the bigger the eventual move that you are supposed to go with. And what keeps on being interesting to me is that the 10s, 30s, the one that I would expect to show inflation fears, is just not moving. It's, just like the 5s, 30s, the 10s, 30s, are we going to touch this line and then collapse? Possible. But I would have thought that if we start trading, significantly better, like 50 basis points, then we really do have the bear flattener that I was talking about a couple of weeks back. But we will see. I am definitely just going to go with a break of these levels. They're all marked on the sheet. And that's, I think, all there is to it. The individual tenures, and these are 5s, which we will start with, and we'll enlarge this chart. I think it's pretty obvious that, look what we did last week. What did we close different? 1.5 basis points. I think that if we start breaking above 85, we will go and touch 97. I think the risk reward in 5s is still to the upside. I just can't see it being to the downside. If we now move to the 10s, the picture becomes much more nuanced. I think the upside is much more capped in the 10s. A break of 139 to 140 is just going to give us slightly above 150, 151. I think the downside is going to be very well protected down here at 124 basis points, 124 basis points. I just can't see it breaking through unless there is a huge flight to safety, which I don't see, because even if equities come off 3, 4, 5%, I don't think that's going to be enough for people to start switching into into fixed income. I just don't see that flight to safety. It makes any sense here. What are you hoping to make in 10-year notes? 3, 4 basis points. If you are afraid of an equity collapse, you are going to buy 3-month bills. You're just, or 1-month bills, or give it to the Fed at 5 basis points overnight. You're just not going to risk your money in 10s and 30s. If we now look at the 30s, what is there to say about, this market which moves almost nothing, 0 basis points on the week when you have a 30-year auction? The auction went well. All the auctions went well. There were like an A plus for the 10, an A minus for the 30s. And still we are here at 190, just bouncing around the 190 level. Do I think it can go up to 2? Yes, I do. I think as the Fed date approaches, people are going to be more cautious about owning bonds, but the long end to me is the one which is the least vulnerable. So there you have it. Every time I'm bearish in 5s, and every time I'm bullish in 30s. As far as Europe is concerned, things are maybe slightly more exciting than in the US, but not very much. This is the bubble. I would have thought it's going to be very well capped around the 61 to 62 basis points area. It's I was right that it was very, there is no value down here, but I find it very, very hard to believe that it's going to go much through these levels. The one that is to me slightly more vulnerable is the Bund. I do think the Bunds can easily trade up here at around the 24, 25 basis points. It just is politically a very interesting time for Germany with Merkel and the elections. Who knows what's going to happen there, but I think it makes sense that over the course of the next week or so, there is a continuation of the move out of Germany and into the other, more peripheral countries with a lot more yield. I have found this website, which shows you the spread between Italy and the Bunds much more accurately. And really, I think the danger is still that we come through the 100 basis points and go down towards the 96, 98 and finally break down. I can actually show you this, the Italian bond. I think it's fairly well capped here around the 80 area, and therefore it's, I think, a lot less vulnerable than the Bund. This is the longer term chart of the Bund against the 10-year note, which is on not as accurate as the one I just showed you, but you can see that if we start breaking through 98, we will very, very quickly be trading these areas around 90. And we could get a breakdown. I think it's still worthwhile playing, because I think the upside is very, very well capped within 2 or 3 basis points of here, and you can set a stop here at 107, 108, and really you're looking for 2 to 1, 3 to 1 risk reward. I don't think the Italian bond will be weakening for relative to Germany for at least a couple of weeks. In my experience, when volatility abandons one asset class, as it seems to have abandoned bonds, it definitely gets transferred to other asset classes. Now, whether that is going to be equities, as we saw on Friday, whether it will continue to be equities, and whether it'll be transferred in part to the dollar is something that I don't know, but that I'm prepared for. I'm really prepared for the dollar to become more volatile. It's just my experience that when volatility abandons one asset class, it increases in others. So whether it'll happen, I don't know, but I have to be mentally prepared for it. And I still have these levels. I think that this time, if we start breaking above 93.14, we will definitely go into the 94s, or at the very least 93.61. As you can see on the dailies, the 200-day moving average is turning, and we could easily get bouts back up to into the 94s, which are these levels here. Why we couldn't trade these kind of levels right into the middle, 94.90, something like that, is, there is absolutely no reason. On the other hand, you really can't get bearish of the Dixie until it breaks 91.41. It hasn't even attempted to break 91.41 on the downside. It keeps on trading basically in a very, very narrow range between 93.62 and just above, which is what, 91.81. That's like 1.5%. When that breaks, that will tell us something, and it'll probably increase volatility. And I would have thought the 95s would be the natural level for it to go. Still very much the same level. If you translate that in Euro USD, you are looking for 119.88 as a very good level to do some put spreads. And here you are looking at this area just above 115, between 114.35 and 115.34 as a good area to look for a counter. But I must say, gun to the head, I would think that the dollar is going to get stronger over the next couple of weeks, simply because people are fearful of what is happening, with the Fed and the QE. Whether we are going to have a little bit of earlier than expected removal of QE, i.e. less QE. So, I'm mentally prepared for an increase in volatility in the dollar. And my favored way is to the downside in Euro USD to these 114 and something levels. Do I have a position? No, because I'm just not that convinced. I don't see the trigger, and I don't see the overwhelming reasoning. But I'm mentally prepared for it. Well, with gold, what can you say? Because if I'm slightly bullish of the dollar and I don't see anything at all happening in bonds, then, I can't really see very much upside in gold. And the story keeps on being the same, and it's been the same for so many weeks, until it starts closing above this 118.30, 18.40 level. What is it? 37, 38. Man, let's call it 118.40. There is absolutely no reason to hold it. On a daily basis, the 200-day moving average is still sloping downwards. Technically, you're looking for 1764 as a bounce area, and you're looking for these levels down here where we had the liquidation, 1710 or something like that, as cheap until something changes. End of story. And I keep on saying that if you want to be hedged against inflation, then DBC is a much better hedge. As you can see, DBC is holding much, much better than gold. and I'll try to enlarge this. It's still doing nothing, but it's doing nothing at much better, higher levels than gold. You really need a weekly close and break above 1950 and to be trading in the 20s to say that you are getting another leg higher. If you look at the lower, the daily, it's really doing nothing. But every time it comes down, there are buyers. And if you compare, the shape of the 200-day moving average in DBC and the one in gold, well, you have your answer. The spread between DBC and gold keeps on going out. So if you want to be hedged against inflation, DBC is the one. I want to start the equity review this week with volatility. What has struck me is that we have, on a daily basis, closed above 2005, which is not, it's not like it never happens. It happens several times. It happened and it wasn't significant. But we've also closed it on a weekly basis, and that is significant because this is the weekly chart, and I'll enlarge it for you now. This is the highest close since March. On we do have these bands where that volatility likes to trade in, and really 2251 is some kind of a watershed. 22 and a half. You can't be that precise in volatility and look to it to the tick. But what it does, what you can see here is that ever since we broke down in March, we have never closed above 2250 in volatility, and we've been trading on a weekly base, on a weekly close basis, always in the teens. And this is the first time that we are actually, you can see how these Bollinger Bands are now moving out. And is it going to be significant? Well, I don't know, but my ears are pricked. I'm slightly worried, and all I know is that volatility always closes gaps, and we still have a daily gap to here, to 2757 from early June. So that's all I know that we have, and to me it's indicative that we broke that 4480 level, and when we did, volatility went up. Could that be a Friday effect, Friday late, not a lot of people around to sell volatility? Absolutely it could. There's a million reasons why this potentially is a false signal. But it's just that my ears are pricked. I told you earlier that in my experience, when volatility leaves one asset sector, it gets pushed into another. Could it be equities? Absolutely, it could be. I don't know the reason why that would be, but I will now try to look for reasons. One of the simplest reasons could just be valuation. I've been saying for a long time that JPM are right. $205 times 22 earnings is 4,510, and that's where we are. And given the fact that we can't go through this 4,500 odd, the market is in a seasonally bad time of year. And would a 4, 5, 6% from that level retracement be out of the question? Could it be impossible? No, absolutely not. It makes sense to me that if a market reaches a very important milestone like 22 times earning of 205, that it takes a breather. And during a seasonally bad time of year like September is, it's the worst seasonality of the year, you get a retracement. Would a 4 or 5% retracement be the end of the world? No. Why? Great. So could it come back down? Absolutely. But it's what I'm trying with this chart. You can see that since all the blue angels are still trending upwards, they're not turning, i.e. there hasn't been an earnings event. Analysts are not downgrading earnings. There is no reason in that case for this to be anything more than a normal 4 to 5% retracement in the context of a long-term uptrend. We haven't looked at the deviations for a long time. And what do deviations say? Not a lot, right? Could we go and test towards the end, towards the bottom of this of these bands? Why not? But that is just not going to break the uptrend. I think the uptrend is well established. It comes in at 44.15, something like that on Monday. Do we get a bounce from it? Most probably. It's going to even if this is a top, it's going to be a process. It's going to take a while. Tops are processes. They're not events. We haven't had any kind of earnings event. We don't have an earnings event on the horizon. We have no reason to believe that we are hugely expensive. We're just in a seasonally bad time of year. People are liquidating. People are going from one asset class to another. A lot of stuff is, inside the individual sectors. So that is, I think, all that's going to be happening. And, having said that, let's look at some important levels for the S&Ps and for the Nasdaq. Well, this weekly chart is a complete mess, but if I enlarge it, I think you'll see what I mean. I really don't think there's much weekly support until 43.71. That is where weekly support will come in. By next week, these moving average will have moved to that area. And if you look at the retracements from the bottom that we had here at 40, 50 odd, all the way up to 45, 45, which has been the top so far, you will see that it matches very well with the areas of support. You have the 38.2 coming in at 43.60, and then you have the 0.618 at this area between 42.47 and 42.32. If over the course of the next 3-4 weeks we touch this level, I think it would be a wonderful bounce level for the fourth quarter. But, first support I definitely think is going to be around the 43.70 to 43.60 area, where we get a decent bounce from as well. With my favorite clean daily chart, I've drawn retracements all the way from March and from the recent bottom in July, and basically they match up very well with the support levels. We've come through the really important support on Friday that I kept on telling you that if we go through, it's going to look a bit bearish. I would have thought that 43.84 over the course of the next 2 or 3 days should trade, and we should have a bounce from. If we really look at the important support, it's not going to be until the 42.55, 42.31 area. I think that area is going to be a very, very nice area to buy lots and lots of call spreads for the fourth quarter. So those are your levels. Really, I think the first support 44.23, 43.84, and then 42.55 is going to be an absolutely wonderful area to buy for the longer term. The real question, though, remains is how we're going to get weakness in the in the stock market, in the SPX. It seems to me that the only way that we can get some 4 or 5% retracement there is if we get some other sectors to participate in the weakness. This is the Dow, and as you can see, basically we've done nothing for months. Nothing at all, which basically tells me that the industrials and the financials, of which this index is very heavy, are doing nothing. Okay, so if and they're just not going up and have not been going up for an awfully long time. That means to me that you're going to get very little help from industrials and from financials, and really the answer has to lie in the only big sector which is left, which is then the tech sector. Basically, the tech sector has either got to now really outperform to make up for the weakness in the Dow, or it has, if it gives up 2-3%, that is how you're going to get the weakness in the SPX. And to look at the tech spreads, this is what I mean. I was getting quite excited on Friday because we were trading above the all-time highs for a bit, and then we closed within them. Always wait for the close. So how are we going to get weakness in SPX? Well, if we now start underperforming in tech, what doesn't go up tends to go down. And could we go back down to here to 33.85, have some underperformance in tech? Absolutely. This is against the Dow. We've been making all-time highs. If we now start coming back, stop everyone out and then go again, why not? All we're doing is coming back and filling to these moving averages and then go again. So as you can see, really the answer has to lie in the Nasdaq. The Nasdaq has to join in the weakness for SPX to be able to have a bad time of it relatively over the next few days or weeks. As I'm convinced that the answer has to be found in the Nasdaq, we might as well look at it. It's actually the least bearish chart of all of them. The one with the most impulsion, the one with the smallest retracements, and that still hasn't changed. On a weekly basis, you really can't get, even remotely bearish of it unless it closes below 15,111. On a daily basis, and let's enlarge this 195-minute chart, it's still the one that's trading the best. It really has to start closing below 15,184 on a 195-minute basis to even, get bearish down for 14,500 and the support of the 200 period moving average. So that is why I just can't see that huge amount of weakness coming into SPX. To me, this is going to be a normal 3 to 5% seasonal adjustment, unless the Nasdaq really changes its picture. As I said last week, to me, this is what we are trading. We are trading SPY EWJ, i.e. we are trading the SPY against Japan, but Japan is really, developed Asia kind of thing. So we were, and I kept on warning that these levels here were unsustainable, and we are back in the channel. And really, as I keep on saying, why not get to 6 where this moving average comes in? So we have a little bit more weakness. So all that I think has been happening is reallocation out of the US, which had reached a very important milestone, which I kept on saying, 205 times 22 times earnings, milestone, brick wall, ceiling, right, we're there, what do we do, what's cheap? Japan is cheap. Do we expect it to outperform? Yes. Sell the US, buy Japan. And it all happened at a time when it was unsustainable on the charts, back down, and that to me is what's happening. If we look at what the Nikkei has done, basically it underperformed all year, and then you get a little bit of political reprieve, bang, it goes right to the level where it should have got to. On the weeklies, 30,415, on the dailies, 30,205, and now it's going to probably, just go sideways a bit. You're not going to get a complete collapse in SPX while the Nikkei is doing this. It's just not going to happen. So now the only way that the SPX is going to trade into the 4300s and stuff like that is if we come back down towards this area of 28,335. This would be the cup. This will be the handle, and then in the fourth quarter we go up. That's the only way it's going to happen, and that really is, it's all encapsulated in these spreads. EM was doing the worst, and now it's doing slightly better than it was, and we are closing. We are mean reverting in this spread. As you can see, this is EM against SPY. We are basically mean reverting to the previous low. We get there, i.e. US underperformance for a few weeks, and then we go again. To me, this is just not the end of the world. To me, this is just a market which had got ahead of itself, being sold on a spread to other markets. Can it go down another couple of percent, SPX? Of course it can. But what I'm trying to say to you, it's just not the end of the world. So let's do the maths together. So if we get a retracement on the Nikkei down to these levels, 28,180, maybe 28,500, where these moving averages are, call that, it's 2, but call it 3%. And if we have a look at the chart that I showed you, to get back in the spread to around the 6th level, that's another 1% on top. So that really basically is saying that the bottom in ES would be around 4% from where we are. That's as bad as I can see it. 4% from where we are here is what? Another 160, let's call it 200 points. So that, what does that give us? That gives us this gap here, basically, around the 4320 area, this kind of area, 4300, 4320. Over the course of probably 2 or 3 weeks. That is basically what you have to be prepared for. I don't think it goes much worse than that. That will get the Nikkei to EEM to SPX relationship back into a normalized trend, a mean reverted trend, and it'll actually make SPX have a much better bouncing point for gains in the fourth quarter. I just don't think the situation in the Nikkei and the situation in NDX allow for a deeper retracement than that. Could it be an extra 1%? Sure, but I just don't see any more than that, because if you do the maths with levels that the Nikkei should now settle at, it just doesn't allow for much more than that. Right, on to the biases. I really have nothing much intelligent to say in the bonds. I really don't. I think the only thing that makes sense to me is the short bunds against the a butterfly of France and Italy, because I think the risk reward is still there for a break in that spread. As I showed you, if it breaks 100, the BTP bund spread, it can easily go another 5 to 10 basis points, and I think the risk reward is still in that direction, because you could easily get a really bad surprise in Germany politically, and that's probably what's going to move that spread. Italy seems to be doing better and better, so there is really not a lot of fear on the upside. I will go with a break of the yield curve, whichever way it comes. These are the support levels in all the equities, and I really don't think that next week we see the huge fear that some people are thinking we see. Do I think that SPX is due because of seasonality and the fact that we've reached the natural ceiling of 205 times 22? Do I think that it underperforms for a while and mean reverts in those spreads we've seen? Yes, quite possibly, but we've seen where that takes us. That takes us to very healthy levels, which are going to be wonderful levels to pick up stuff for the fourth quarter. Anyway, you have it all here, and I see no point at all in owning gold for the time being. Thank you very much indeed, and tweet you on Monday.